Okay, welcome everybody. I was just mentioning a second ago, we've got a Rotary actor potentially joining us from Spain. He's just having a little bit of trouble accessing the Zoom link. So if he does make it on, I will try and introduce him. It would be nice to hear from a student who's looking to do some voluntary work here in Leicester as part of the Rotary Club. So welcome everybody to this meeting of the Rotary Club of Leicester. It's the 22nd of February 2021. Do we have any guests with us today? I haven't seen any yet. No, not okay. And any greetings from other clubs? Yes, John?
I've got a couple of greetings. One is from Howard Gelly, president of Spalding and Welland. I visited their club a week last Monday. And I also, on last Thursday evening, I attended an International Rotary alumni meeting held from America. And I met a Donna Rose Hoochin from Malibu, California. And it turned out that she'd been an ambassadorial scholar at Leicester University in 1985 and hosted by the Leicester Rotary Club.
Oh, wow.
She remembers her time well. Stan Vaughan was her counsellor. Alan Easton was the president at the time. And she had a really successful year. She went on to become editor of Harper Magazine in America. But she's still in touch with Stan Vaughan's family. He died a few years ago, but his wife Helen's still alive. She's 90 years old, and she comes over most years to visit her. So an interesting evening.
Oh, I wonder if we could invite her to come and speak one day. I bet she's got an interesting story to tell.
I'm sure she would actually, yeah.
Yeah.
Unfortunately, the time lag's a bit of a problem. She'd have to start in the middle of the night.
That's true.
Oh,
yeah.
we could in that case, we could pre-record.
Oh, yes, that's a good idea. Yeah, tell me the details through, John. I don't mind asking unless you want to do it.
Yeah, I'll brief you all about it. Okay.
Yeah, wonderful. Thank you, John. And do we have any other greetings? Okay, all right, thank you. Barry suggested a wonderful idea, I thought, just before we started the meeting, which is perhaps we could dress smart for the meeting of the 15th of March. So if anybody's would like to join in, how about wearing a tie on the 15th, the meeting of the 15th. So put that down in your diary, just as a bit of fun, considering none of us have, well, most of us haven't worn smart clothing for a long time. So let's try that on the 15th. I'll make a note.
I don't have a tie.
Yes, that's why I changed it to smart clothing. Yeah.
Best to say, yeah. But
you have to get that in somewhere more.
Perhaps you can lend one or two people them. I'm not sure where I've got mine these days.
Okay. So I just also I'd like to mention, yes, Richard.
Yeah, I've done. I forgot some Ethiopian update. That was all. Just if you
please go ahead.
Yeah, no, Lawrence is out there this week. He's managed to fly up from Addis, and he sent me a WhatsApp this morning, which I thought you'd be interested to hear. And I will read it to you because that's easy. It's very, very busy here. They received 40 new patients on Saturday from the Tigray region, many gunshot wounds, femur fractures, tibia, etc. The guys are playing it down and seem very humble about how hard they have worked. Lining up a whole bunch of elective cases for Wednesday, Thursday, and Friday. Hopefully, there will be time. We're having our first virtual Leicester Gonda orthopedic meeting tomorrow at midday, and our donations of external fixators sadly is still in Addis Ababa, but there is a route. They will get up there shortly, but there's going to be no shortage of clients for them. But anyway, I just thought I'd keep you up to date because the news would have you believe that. The conflict in Tigray is over, but sadly, I'm afraid it is it's nowhere near that.
Okay, yeah, I was going to say, I mean, the sort of the media attention on it has disappeared, hasn't it? I've not seen it.
Yeah. Well, that's as it would. They sort of focus more on the aid element of it now. So the displaced people, which is pretty huge as well.
So the trauma unit that you helped put together,
Yeah.
what sort of role is that playing in this then?
Well, they'll be treating all these people.
Right.
I mean, basically, before we put that stuff in, these patients would have had virtually no. I mean, they just simply wouldn't have been able to. They would have all just been put on traction and left somewhere. Whereas now they can properly treat them. They can put on external fixators. They can fix the fractures. They can get them up and get them out of hospital. So and also they've got the expertise there to do it now, because they've got 4 fully trained orthopedic surgeons plus the trainees as well.
And do they have a sufficient inventory of materials and things that they'll need?
Well, they've got. We gave them 1 year's worth of implants, and the deal was that during the course of that year they would then set up a system of procurement, which is very possible. You know, it's done. When I went down to Hawassa last year, whenever it was, you know, they'd set up a procurement process mainly through stuff from India, which is obviously a huge lot cheaper. And that's one of the items on the agenda for tomorrow, is to find out how they're getting on with developing that process. But they've got a year's worth of stuff there to keep them going anyway. So hopefully, you know, through to most of 2021.
What about the rehabilitation of the patients? I mean, getting them.
Well, that's the next battle. So I've got as you know, we've got the not our club, but the East Caribbean club developing the Jaipur Limb Centre, which we hope is. I think, and then the other thing that we've just through Hale, we've just submitted last week for a grant application to Hale for £300,000. I'm afraid so. I'm not sure it will get through, but that is to look at enhanced recovery throughout Ethiopia, but using Gonda Orthopedics as a pilot site to really try and improve, because that is the next big battle, is the rehabilitation element of it, which again is fairly limited.
Yeah, well, wonderful efforts there, Richard. Well done. I've just seen Beatrice from the Universities of Leicester Rotary clubs. Welcome, Beatrice. I've just seen you on the second page.
Thank you.
Are you doing all right?
Yes, I was a little bit late because my internet connection wasn't that good.
Not to worry, not to worry. So you guys are okay? The students are generally keeping well?
Yes, they're still in their home countries, the majority of them, due to the lack of flights.
Yeah. Well, hopefully we get them over here soon and we can start to get involved in some projects.
Yeah, I've already thought of some projects we could do.
Oh, great. Okay, well, we'll discuss that at another time. Good to have you with us. Thank you. Okay, so just going to move on. Do we have any other notices, Barry, Secretary?
No.
None? Okay, any other committee chairman would like to mention anything? Yes, Nick?
It's just a brief word. We've got John Knight here today as a guest, but hopefully not for much longer. Loros.
What's happening to him?
Not for much longer as a guest, because Loros are applying for corporate membership, our first corporate membership, and I'm just about to get out to Barry a 7-day notice, so that'll be coming round to everybody shortly.
Great news.
That's it.
Yeah, excellent news. Well done, Nick, and well done, John. Okay, David Brunton, would you just like to mention quickly about the first donation we've just made to Rotary for food banks? I think we've sent them. Have we sent them the first £1,600?
Yeah, there's 3 food banks approved and wanting to deliver it. So we sent £1,650 to the organisers, and they've allocated it £550 to each. I think there's some problem at the moment with the ordering system with Morrison's, and they're just checking through that. But once that's sorted, they will be able to go out to the food banks and let them make an order.
Is that something I read about reconciling the VAT, or there's some issues around that?
Yeah, something to do. I think they've added a lot more items to the options on the Morrison's list, and quite a few of them have got VAT, because obviously generally food items haven't got the VAT on. So when they put the prices up, they show them without the VAT, which can cause a problem if they select items which come to £550.
Yes.
And suddenly they're stung with VAT on the top because there won't be enough in the kitty.
Yeah, that makes sense, doesn't it? Because this is their wholesale purchasing platform, isn't it? Which I
Yeah.
guess is going to people who are VAT registered. So it's,
Right, yeah. So they need to know the difference. So
Yeah.
Susan at the food bank is just sorting through that.
okay, great. Well, thanks for your efforts on that, and it's great to see the first few deliveries now ready to take place.
Yeah.
Excellent. Okay. I think that's
to make our donation to Netherhall School.
Oh yes, please talk about that.
Well, yeah, I got the details. Obviously, they've been on holiday last week, so I've only got the details this morning. But I've just tried paying it this morning, and it bounced back. It said this account's not recognised. So I've just gone back to them to see what's happened. But it looks like we haven't lost the money. It's come straight back to the account. But
Is it a case where the company name doesn't match the bank account name, or?
well, that's what I thought it was. But now they're saying the sort code doesn't match the account details. But
Okay. Must be a typo in there somewhere.
yeah, I think so.
Oh, that's really good, isn't it? That's about 1,400, I think, was it?
Yeah, 1345.
We've also made the donation to Foundation.
Yeah, we sent 3,800 to Foundation, which will probably bring us up to about what our target is for the year, with other donations that some people make individually. So we won't follow up our target. Really.
Wonderful.
So yeah, we've given out quite a bit this last week.
Yes, maybe we should get some more money in now. We'll work on that.
Okay.
Okay, so it'd be nice if anybody knows of any projects we can get involved in. I know Beatrice and the students, myself, other members are very keen to get involved in further projects. So we have the Netherhall School we're working on, and any other projects you've got in mind or you've heard about, please let me know. Okay, without further ado, I'd like to make sure Ed is here. Yes, Ed's still here. Yes, excellent. Okay, so our very own Ed Cuffling is going to be talking to us about investing through and beyond a global pandemic. Please take it away, Ed.
Thanks, President Parmdeep. Hello, everybody. I'm going to try and share my screen in a minute. But first, just sort of a bit of an introduction. I did a job talk when I rejoined Rotary a year or so ago, when I didn't really talk about my job. So I'm going to give you a bit of a background of what I do, and then try and talk you through the whistle-stop tour of what happened in the last 12 months in investment markets. And it's been quite a lot, so buckle up. Right, so let's get into here. Can you see that? Can everyone see that?
Yeah.
Yes,
Yeah.
I can see. Yeah.
Right. So if I go into here, okay. So what I'm going to go through, as I say, I'm going to talk to you a bit about what I do, what happened last year, what impact that had on investment markets. As if you've got any investments, a pension, for example, you kind of know what happened, but I'll try and give you some background as to what happened. Try and talk about then what we did as an investment group to try and survive and thrive through the COVID pandemic.
Ed,
Give you a bit of what, yeah.
Ed, sorry to stop you. Your notes are appearing on the share screen.
Okay. They're not actually my notes, which is interesting.
Oh,
Can
okay, fine. I just thought I'd let you know in case you didn't.
Yeah, no, let me just see if I can share. I'll unshare that one.
Yeah.
You should be able to share the full screen version. I wonder why I can't do that. Not giving me that as an option. So let's try again. We may just have to go back to. Can I delete those? Oh well, try and ignore those. I can't get rid of them. There's nothing in there. There's nothing rude in them, I don't think, so you'll be okay. A bit of portfolio positioning, a bit of recent activity where we are. So a bit about what I do. I'm an investment manager with Charles Stanley in Leicester. We've got quite a small team based largely in the Mercury building. We look after just short of £500 million for our clients, which concentrates the mind, I have to say. Of that, roughly 80–90% is managed on a discretionary basis. And if I give you an idea of what we invest in, you'll get a picture of how we do it. So on the right-hand side here, we invest in UK shares. That's the shares of companies listed in the UK. International shares, fixed interest assets, that's gilts, government bonds and corporate bonds largely, commercial property assets, and the new term alternative assets. Alternative assets are kind of everything that doesn't fit into those other categories. And they include recent sort of ideas like infrastructure assets or absolute return funds or private equity, things that don't fit neatly into the other buckets. And they are the traditional asset classes. There really isn't much else that you can invest in that's not rather eclectic. I mean, you could look at vintage cars or wine or stamps, but they're just not really a tradable market for investors to invest in. So these key assets haven't changed. And when I learned about the industry 30 years ago, it was the same assets. The company names have changed, but they're still the same. We invest across roughly 1,200 client mandates, and it's key for you to know that all of those portfolios are different. These are not pooled funds where everyone has the same. We manage 1,200 different client portfolios, which is occasionally like herding cats, but largely people's motivations are the same. They want to grow their wealth and have it ready to spend when they need it. So while we've got lots of different moving parts, they all tend to travel in the same direction. So what happened in 2020? Well, the triple whammy for investment markets. You had COVID-19. We all know what happened with COVID-19. We're still in the middle of it. We had Brexit. Don't forget that. Brexit was a key driver in investment markets, particularly at the end of 2020, when the threat of no deal was still very much hanging over the market. And dear old Donald Trump, you know, what he was the most mercurial president who made the most bizarre decisions and policy actions. And you'll see in the charts coming up what impact he had on investment markets. And to see the back of Donald Trump, I think investment markets have all blown a huge sigh of relief because he was a difficult man to follow. But the key thing was COVID-19. Of course, it wasn't just on a business footing. I'm working from home. I've been working from home for 9 months. And I have to admit, I was wrong. If you'd have asked me, could we do our jobs from home? I would have said pompously, oh, we're collegiate. We're far more important than that. We have to be in an office together. I was wrong. We've managed with our technology to work really well, very collaboratively. I'm completely connected and switched on. And actually, I have to say, I prefer it. I can't see myself going back to working from an office permanently for some time. So those three factors had a real impact on our investment world. You've seen the asset classes we invest in, but the key one that really drives investor performance is equities. And if I show you what impact COVID had on investment markets, if you look at this chart, we've got starts at sort of July 2018, and runs through to today. And you see markets went along quite nicely. At the end of 2018, Donald Trump was shutting down the US economy effectively. Markets had a bit of a wobble. But what really happened was this. At the end of February, beginning of March, towards the end of March 2020, equity markets dropped by 35% in a couple of days, really. And that is dramatic and worrying. And as investors, we had to try and make sense of what was going on. Now, there is an adage in investment markets that markets hate uncertainty. And no one knew what COVID was. COVID was a global pandemic emerging, and people were getting very ill and dying, lots of them. And that was very worrying for us as a society, for us as a world, but for investors, because it had a huge economic impact. And when Boris Johnson put us into lockdown at the end of March, it appeared that parts of our economy may never survive. and markets fell. But we as investors had to circle the wagons and think about what the impact of that was. Have we seen anything like this before? Well, as it happens, we kind of had. Now, this chart goes back to 2007. And if you look at this movement here, the global financial crisis, the collapse of Lehman Brothers effectively, and compare it to this, there is a huge similarity. The shape of the downturn is very similar. This one is more accelerated, but the recovery is also dramatic. And we took stock and said, hang on a second. Yes, parts of the economy are closed, but many parts are still open and actually functioning well. The 2008 fall in markets was driven by mismanagement of banks, of a debt crisis, of probably a natural correction in the world economy, whereas the current position is forced. It's government policy forcing parts of the economy to close, that if we can get through the pandemic, we'll reopen. And so what that told us is that actually, if we remain steadfast and invested, you may well be rewarded for that steadfastness. It certainly wasn't a time for panic, that's for sure. But one other thing was really interesting that we noticed quite quickly is that if you look at this graph, this goes back to the beginning of 2020. The red line is the American S&P 500 market, and the black line is our own FTSE 100. And if you look, you see that while our market did have some recovery, the S&P 500 was much faster. And that really shows that the UK economy and the UK stock market is dominated by the old economy, you could call it that, by oil companies, by banks, by insurance companies, whereas the American market is dominated by technology companies. And it was technology companies who really benefited from COVID-19. Think of Amazon, think of Netflix, think of Alphabet, which is Google's parent company. They've all survived and thrived through this. So as investors, we've got to work out what we need to do to respond to what's going on around us. So our investment management response was remain invested, which was tough. And as you see at the end of this slide, that we had to communicate that, but we decided we wanted to remain invested. We may change what we actually have, but we stayed invested. We had to think about what change, what economic and societal change was going to be permanent. And so we decided to remove exposure from portfolios to what we considered were damaged sectors: high street retailing, travel, leisure, commercial property, and banks. Now, commercial property is really interesting. You could see a trend of working from home. I'm doing it, a lot of people are. And high street retail is a big part of commercial property. And those two parts, high street retail and metropolitan office, we just think are going to struggle for some time to come. We also try to add exposure in portfolios to what we see as the COVID beneficiaries. So technology shares, biotechnology, healthcare, online logistics, and more importantly as well, or as interesting, Asia and emerging markets, because we saw that Asia and emerging markets had COVID first, dealt with it quite well, but actually allowed their economies to reopen more quickly. And by building exposure to those areas, we've actually managed to really help our portfolio survive. And then the last thing we had to do was communicate. And as I said here, Zoom, Zoom, Zoom. Who'd have heard of Zoom 2 years ago? But I've now got so used to it that I can't see us going back to many face-to-face meetings. You know, Zoom is very convenient for people. I can effectively be in my clients' living rooms without leaving my room, and they are very comfortable too. So the advent and adoption of these online communications are going to be revolutionary for our business. And I think it's great going forward. We should carry on doing that for some time to come. So we acted quite quickly and it worked. But more recently now, we've now got to decide what of those changes is temporary. Now, Boris Johnson's going to talk to us at 7 o'clock this evening, and he's going to talk about unlocking. And we're starting to shift, to pivot portfolios into those unlocking trades. These companies that have suffered, that have been unable to trade through lockdown, are not bad businesses. They've just not been able to trade. So we've started to build exposure to leisure, hospitality, and the staycation story. I think international travel is going to struggle, but the staycation is on. And I think Boris is going to gradually allow us to do that. So we're starting to put money into some leisure activities that are currently closed but likely to reopen. But we're not notably getting back into commercial property, retail or travel. Those areas I think are just pretty hobbled for some time to come. We are reducing, interestingly, exposure to what you might call the COVID safe havens. If you think about what we've been able to do for the last 12 months, we've been able to go to the supermarket and we've been able to do some cleaning. And so those companies who give us our regular staples, the food companies, the cleaning product companies, the supermarkets have all had a good year. But the situation isn't going to improve for them. They've got an absolutely golden opportunity here and they've taken the best of it. We're now starting to pull money out of those areas because the situation can't get better for them. And there are two other things that we think are going to happen. Governments are going to push the green economy story. We've seen the UK government bring forward its requirement for no more purely petrol or diesel car sales from 2040 to 2030. That's a big shift. There's got to be an infrastructure built around that. If we're starting to drive electric cars, where do you charge them? Who creates the electricity? How do you do it sustainably? So we think that green economy is good. And also the government spending kickstart. I think Western governments are likely to try and stimulate the economy rather than tax to raise the money to pay for COVID. And that's going to mean infrastructure projects. We've seen high HS2 perhaps being pushed through, and then regeneration and redeployment. And the redeployment story, I think, is changing what property does. We've seen the collapse of Philip King's Arcadia Group, all those empty units. Now, they're not going to become homes, that's for sure. But I think governments and policymakers are going to try and encourage people back to living into cities, which means there's more demand for leisure and other activity that those units can then be used for. Interestingly, one of our colleagues is John Redwood, the MP, who's not everyone's favourite person, but he is part of a group in Oxford changing retail spaces into residential spaces and doing really well with it. So where are we now? Well, the macroeconomic conditions for investing are becoming slightly more supportive. Our tailwinds, things that are good for investors, for risk asset investors, well, lockdown easing, that's clearly going to be good news because parts of the economy will open up, which means that economic activity will start to grow, which is generally seen to be good news for investment markets. Pent-up demand. There is clearly a lot of money not being spent, but moreover, statistically, in the American economy, there is an estimation of household savings increasing by $1 trillion last year. $1 trillion, that's a lot of zeros. And in the UK, there's a statistic that excess savings went up by £125 billion. So people who are still working, but working from home, are not spending money on vacations, on travel, on those parts, and they've managed to accumulate wealth. So savings is going to be quite important as a headwind. We've still got very accommodative policy from governments and central banks. So interest rates are low, tax regimes are quite accommodative. VAT has been cut on a lot of things in the UK, for example. And the last one, which is a bugbear of mine, is that the USA is returning to the normal diplomatic table. Donald Trump's spat, fights, argument with the Chinese was really damaging for economic confidence. And I think we've seen the Biden administration already saying we want to compete with China, but not have conflict against them. And that, I think, is positive for the general well-being of the global economy. But we can't ignore the headwinds now. We're in February 2021. Inflation is out there. Inflation is generally seen as bad for economic activity because everything we want to buy costs us more. Now, inflation may be technical in the fact that utility prices are going up. That's just a factor of what happens in the UK. And that some VAT and tax accommodations are going to be taken away. They may be reversed as the economy strengthens. I'm not sure inflation is the big bogeyman that a lot of people are saying it is. We clearly have unemployment, but without wanting to sound too unkind, those jobs that have been lost are not those that are the economic heavy lifters. It's casual labor generally, it's maybe working in the leisure sector, which will come back. but the people that have stayed in work in the professions are going to do more heavy lifting. But unemployment's a problem. It's got to be paid for. There's a statistic that furlough is costing. I'll just check my notes. The cost of furlough is something like £300 billion in terms of the actual cost of the pay packets, but also the tax that's been lost. And that's remarkable. There's a risk of more lockdown for longer. I'm not sure. The government's really trying hard to stop that, but there's always that risk of variance. The real risk, I think, is the expansion of debt, the amount of money governments and people are borrowing to get through COVID. Who's going to pay for it and how? And that comes in the form of taxation. And tax is money taken out of the economy, effectively. Yes, it goes to the government and they should recycle it, but that's a headwind for investors, I think. So as investors, you've got to think, well, we're poised for unlocking. How slow is that unlocking going to be? Well, Boris is going to help us today, with a lot of hints in the media already. I suspect that by the beginning of the summer, you'll see a lot of relative normality back. It still won't be quite what we think it might be, but I think we're going to get quite a little bit of back. Those golfers among you, it looks like we're going to be back on the golf course on the 29th of March. And that brings all sorts of differences with us. Summer holidays, yeah, but probably in the UK. And then the longer term fear is, what does the autumn and winter look like? And that really depends on how the variants go and how the vaccines work. But the question, I think, on investors' minds is, who on earth is going to pay for all of this, and how, and when? And that is an unknown. My sense is that Rishi Sunak won't do too much in his budget yet, but he's going to have to raise money from somewhere. And they're going to try and stimulate the economy to do that, but there's going to be some tax changes. I imagine there's going to be a tax on online retailing in some way, shape or form, which could raise a lot of money, actually. So what have we done in portfolios? Well, not much in terms of where we put the money, actually. It's just what's underlying it. We're still pretty risk averse. We've still got that foundation stone of fixed interest assets. They've been dull, but that's what they're there for. Fixed interest assets just bring in a return annually, come rain or shine. We have a four-pronged approach to it. There's gilts and corporate bonds. Those tend to be quite affected by inflation negatively. So we also have high yield and infrastructure debt, which tend to be good in terms of inflation. One, because it's quite short dated, and the other because it tends to be index linked. We've still got plenty in UK equities. We think they're cheap. Looking at those unlocking trades and staycation trades, statistically, UK shares are 40% cheaper than their American peers, which is a combination of Brexit, really, that no one liked the UK market. But if you look at a British company that is the same as the American equivalent, they're 40% cheaper. And I think that's a huge opportunity for investors. We're still invested quite significantly in overseas equities. That's a big part of our portfolios, with a bias to the US technology and biotech. They just seem to be that the COVID winners, I think, keep winning. Commercial property, we're still in it, but not in those traditional areas of retail and office. We're looking at healthcare because doctors, it turns out recently, don't really tend to own their facilities anymore. They tend to prefer to rent. So healthcare, warehousing and logistics, we just think online fulfillment, online retail is going to be massive going forward, and it's not going back. And frankly, a lot of the high street retailers have disappeared anyway. And then a growing part of our portfolios is the green and alternative story. I think government policy is really going to push this agenda. It's becoming investable. So think of wind farms, solar farms. There was a time they were so expensive to set up and subsidized, you couldn't really invest in them, but you can now. And private equity is a big part of our portfolios at the moment, because we just see these private company owners starting to see stock market buoyancy as a method to release value from their businesses. We've seen companies listed like Dr. Martens recently and Moonpig. I mean, Dr. Martens has come out with a market capitalization double Marks and Spencer's. Who'd have thought that was possible? So just some thoughts. These aren't tips. I've got to be clear here. These are not recommendations, but these are things we've bought recently. In our portfolios, companies like Galliford Try, the big UK construction company, if the government's going to spend money expanding the economy by creating more jobs, developing infrastructure projects like HS2, Galliford Try is going to be in that scrum. I've recently bought shares for my clients in Cineworld and City Pub Group and Hollywood Bowl. they just seem to be places that people are going to want to go to if they're allowed out. It may be a while till we're allowed to do it, but it's going to come. Micro Focus International is a big software vendor. It consolidates company software together. It had a horrible year last year, but looks like it may be set to have a better one this year. And then a couple of specific areas in environmental assets and biotechnology. But more importantly is the stuff I've sold. I'm selling out of oils. I just think the green economy story is not going to let these big companies pivot quickly enough. And I think they're going to be overwhelmed by their size before they can actually turn into what they want to be. BP, for example, is trying to buy wind farms. It owns a lot of electric car charging stations, but it's still got a lot of dependence on carbon. And I think it's going to struggle. I've sold out of banks and commercial property, Lloyds Banking and British Land, just because I think they're going to struggle this year. And then on the bench, stuff that I think we ought to be really buying, Marks and Spencer's. I've just said I don't like retailing, but did you know Marks and Spencer's owns half of Ocado's retail business? And Ocado is the online grocery retailer. And then Greggs is really an opening up story. Greggs tend to be at train stations, on high streets. They need footfall. And if we get back to that, they're going to do well. And the last one is AstraZeneca, which any of you that buys or owns shares will be surprised to see that AstraZeneca shares are 25% below where they were at the beginning of last year, which doesn't make any sense. This is the producer, one of the biggest vaccines. But of course, markets can't monetize philanthropy. AstraZeneca said it won't make a profit from its vaccine during the pandemic, which is very noble, but no one knows how to price that. But in the future, they will start to profit from it as it becomes more of a regular thing. So AstraZeneca, I think, is interesting. So, you know, it's been a really wild year. If you'd asked me, any one of those factors of COVID, Brexit and Trump would have made a year very difficult, but all three has made it super challenging. It's been very fulfilling to work from home. This slide tells you that you shouldn't really listen to anything I say. It's a disclaimer. What I've mentioned in terms of companies are not recommendations. And, you know, it's been an interesting year. I have generally slept at night, but some nights have been more fitful than others. So I shall stop there and invite any questions.
Thank you. Thank you, Ed. No worries. Yeah. Thank you, Ed.
That's okay.
Yeah. If you can just bring your presentation.
Sorry, let's get rid of that.
No worries. No worries. I can then see everybody. Excellent. Thank you. Do we have any questions? And if you have a question, please put your hand up so I can see you. And then Tony, yes, go ahead and unmute yourself, please.
Thanks, Ed. That was very interesting. Could I just ask, you mentioned something about UK market, FTSE is underpriced by about 40% from the US market. And I've been reading this for several months now, and we said Brexit was the problem and Trump but it seems to not, you know, all those problems, we've got the vaccine and we seem to be coming out of it gradually and slowly. When is there a wall of money waiting to go into the UK market? And why I mean, the market's drifting down again today. When's this gap going to close, do you think?
I think the problem is that if you'd have asked me that 20 years ago, the UK market back then was about 20% of global markets. It's now less than 5%. So the UK stock market isn't on international investors' radar a lot of the times. The people that are buying in tend to be corporate buyers. So we're seeing a lot of takeover activity. And I think that's what we're going to see, Tony, is going to see companies being bought out by international counterparts. So there isn't a wave of investor money, individual investor money out there, but there are the corporate raiders who come in there with big checks and take over businesses. I mean, we've seen the games company Codemasters went, Marston's has been bid for, Green King went last year. I mean, you're brave to buy a pub and bar company right now, but I think it's going to come. And I think there'll be a gradual shift. We're seeing money coming in, but it's not a huge amount because I speak to my father-in-law in the States and he says, I don't understand the UK. I mean, we treat you like an emerging market, which is like, well, that just says everything, doesn't it?
Thank you. Any other questions? Yes, Michael. And then
thank you for a fascinating talk. You mentioned private equity. How difficult is it for you to get your clients involved in private equity? Seems to me that it's very much a closed shop.
It is and it isn't. It's one of these sectors that, with the expansion of investment trusts to now invest in what we might call illiquid assets. Investment trusts used to be just baskets of shares back in the day. You remember those? But they're now creating syndicates that invest in a variety of things, including private equity. So we can, through a number of companies, Standard Life, for example, the Scottish investor, used to invest for its own clients in private equity, but now it runs an investment trust that sits alongside its own clients. So you can get exposure to a variety of things. So it's relatively easy these days. What you can't do is easily control the underlying assets. You cede that control over to the managers, but it's becoming very investable again through, as I say, Standard Life, Harbour Vest, one or two of these big businesses, and they're not just black boxes anymore either. So it can be done.
Okay, thank you. And Chris.
Yeah, thanks, Ed, for that. What I was wondering about is, bearing in mind that the US market's sort of effectively an all-time high, do you believe there's going to be a correction sometime in the coming weeks?
It's the perennial $64,000 question that I always get asked when markets get to new highs. They've got to come down, haven't they? Yeah, they have wobbles. Markets generally do, but you look at the price earnings ratio. It's one of the metrics to gauge the value of a company. Apple, for example, is at all-time highs in terms of its price, but on a price earnings ratio of about 40 times, which is not really eye-watering. You'd think it might be a bit higher than that. Tesla is on a very high rating, and one or two others are. They may have small corrections, but I think there is such a sense of pent-up demand that we see 2021 as a year of rising stock markets. There's going to be fluctuations, but I think mind your eye in 2022 as conditions become less benign, and we know where we are with the virus. I think it's prone to perhaps falling a little bit, but markets have to go to new highs at some point, and I think this is one of those years.
Okay, thank you, Mark, and then John.
Thanks, Ed. One question. What's your view on the investing in Bitcoins?
I knew this would come up. I've actually got a chart which I might be able to share with you. Let me just see if I can get into it. Bitcoin, I think the problem with Bitcoin is currently you can't invest in it in the UK. It's not a regulated asset, which is problematic. If I can share this with you. There it is. Can you see that Bitcoin chart?
Yep.
So this is Bitcoin today, $53,000 of Bitcoin, which is bonkers. But if you look, earlier today it was over $58,000. So it's dropped 10% in a day. I mean, if you look back over a year, you might think, well, this is a no-brainer. You could pay $5,000 for Bitcoin, and now it's worth $53,000. I think the reality is it's a bit, to me, reminiscent of what happened with the railways and canals back in Victorian times. The adage always was, don't invest in the railways and canals, invest in picks and shovels. And I think you can benefit from this sort of movement in Bitcoin by being involved with things like server centers, cloud computing. There's a company in the UK called Argo Blockchain, for example, bonkers name, and that is a Bitcoin miner. It's making huge amounts of money just selling this stuff on to other people. So I wouldn't invest in Bitcoin myself. I can get the argument that money can be made and lost, but there's too many scams around it. It's unregulated. And interestingly, recently, the FCA warned investors in the UK, do not invest in Bitcoin. So mind your eye if you're thinking about it.
Okay, thank you. I have a question, Ed.
Not, but thank you.
Yes, my question is a bit more. I'd like to know a bit more about what John Redwood's doing. You said he does retail to residential conversion.
Yeah, so he's been involved for a long time investing in Oxford. He's an Oxford graduate, and although he lives and represents a constituency in Berkshire, he still goes up there quite a lot. He's very involved with his college, and it is really just urban regeneration. It's that planning and developing the transition from retail to more residential. The city of Oxford, like a lot of cities, doesn't have a lot of people actually living in the city. People have migrated to the suburbs and they're commuting in. I think he and his group are trying to get more non-student life into the city itself, and that is born around the regeneration of old office space, tired retail. I mean, look at Leicester for an example. You'll see that the peripheral retailing is disappearing around the High Cross. I mean, Market Street's devastated, Granby Street's devastated. Everything's migrating into these central centres, so it leaves this vacuum between the population and the retail. And I think what John's doing is saying, look, let's get more people living here first and foremost, and that will then develop into specialist retailing and more leisure and hospitality activity. So yeah, it's a slow burn. It's going to take a decade, if not a generation, but I think there's merit in it.
Well, yeah, I agree. I'm a developer landlord, and I did a deal last year. I converted a post office, which I paid 70,000 for the freehold building. I spent 58,000 converting it into 3 flats, so about 130 all in. The property is valued at about 250 for the 3 units, and my rent roll is comes to 18% gross return on what I spent. So you know, if anybody in the group knows of any similar commercial properties, please give me a call. Cash available to buy. So you know, all your comments on retail property were really kind of music to my ears, because the fact that people are running away from it makes me even more interested. And also, as you might know, the government have changed the rules on conversions. So they've created a new permitted development regime, meaning you don't have to go through the full planning process. I had planning within 7 weeks without any hassles whatsoever. So it's really good.
The challenge is to coordinate it in a sympathetic and well-planned way. City councils and planning departments have really got to try and build an infrastructure around it. I mean, I had cause to walk around Leicester's Market Square not terribly long ago, and you thought, crikey, this could be really great, but it's desperate at the moment. Yeah,
well, Debenhams is going to be 300 flats.
Yeah.
So, yeah, High Cross have put in some permission for that. So let's see. Excellent talk, Ed.
No, thank you. Great pleasure.
Yeah, really appreciate that. And Simon Gravett to give vote of thanks.
Ed, thank you so much for a very detailed run through so many aspects of the economy and its impact on investment. I think just the questions from our Rotary colleagues have highlighted how interesting they've found today. Suffice to say, thank you, and we will keep an eye on the shares and the investments that you have highlighted, but we don't treat it as advice. But thank you for it anyway. Thank you.
Thank you, Ed. Okay, brilliant. Okay, and if Richard, we have Richard on board. So if you don't mind, could you have an update on the latest COVID situation in Leicester?
Yes, the last couple of weeks I've sort of tried to strike a bit more of an optimistic note. I think the sad to say it's not quite as optimistic as it was. The number of COVID patients in hospitals actually gone up a little bit over the last week, and the mortality remains stubbornly high. So it's interesting because the national picture seems to be more that the vaccine seems to be having an impact, and also the claim is lockdown as well. But that doesn't seem to be the case just at the moment in Leicester. And a lot of that, sadly, I have to say, is within our Asian population. For quite a number of different reasons, which I think the research, and I think there's a lot of research going on at the moment, and I think it'll be very interesting to see how that pans out over the next year or so. But I mean, it will start to tail off eventually, but it just isn't doing so at the moment.
How about the vaccination drive? What stage are we at now?
The vaccination drive, I mean, is clearly seems to be going pretty well, and hopefully, those areas that have been not exactly resistant but less uptake, which is in the BAME fraternity, will increase as well. I think the slight concern I have is that we are seeing still quite a lot of elderly people who have been vaccinated who are still dying. Now that admittedly that's usually within 1 to 2 weeks of the vaccine. So, and it is thought that you don't really build up an immunity for at least 3 to 4 weeks. But I think that there is a bit of a concern is that for a vaccine to work effectively, it needs to have an immune system to stimulate, to work with. The patients who have been largely succumbing to COVID have been the very elderly patients with multiple comorbidities, and it's the same people that probably are not so good at mounting an immune response. So I think it will be interesting. I think we'll see the infection rate certainly going down with the vaccination substantially, and probably the hospitalizations, but I think the mortality element of it will probably stay higher for longer. But we will see, and I suspect that probably is. I think it would appear that the government's approach to lockdown is being ultra cautious, and I suspect that probably, although they're giving out good vibes about the vaccination, and I think underlying it, I think they're being told quietly in the ear that actually perhaps you just need to back off a bit, because I think it's going to take longer than you think.
Okay, thank you for that update. Do you have any questions for Richard? No? Okay, all right. Thank you very much, Richard, as always. Next week, if everybody could just go ahead and unmute yourselves, we can say goodbye. Next week, we have Lucinda Wessel, I believe I've pronounced that okay. Surgical matron of the Royal Free Hospital. She'll be talking to us about reflections on nursing during the COVID pandemic. Attendance today has been 27. It's great to see you all. Stay well and stay safe, and I see you all. Look forward to seeing you all next week. Take care. Goodbye.
Bye.
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 Cheers, James.
Bye.
Bye, Tara.
Bye.
Right.